central bankers and the inflation crisis, a deliberate act or a consequence of policy. In recent years, there has been growing concern that central bankers, under the influence of powerful backers, have deliberately engineered economic problems through policies such as excessive money printing. This has led to inflation, a situation exacerbated by the misallocation of newly created money. Rather than directing funds to sectors that could stimulate widespread economic growth through a multiplier effect, these funds have been funneled into major financial institutions and Wall Street, benefiting a select few while leaving the general population and future generations burdened with increasing debt. The role of money printing in inflation. One of the most contentious issues in modern economic policy is the role of money printing by central banks. Critics argue that this approach, often described as quantitative easing, is a primary driver of inflation. When central banks print money, they increase the money supply, which can lead to higher prices if not matched by a corresponding increase in goods and services. For example, in response to the 2008 financial crisis and later during the COVID-19 pandemic, central banks around the world, including the Federal Reserve in the United States, implemented extensive quantitative easing programs. The intention was to stimulate the economy by making more money available for lending and investment. However, this surge in the money supply has been linked to rising inflation rates. In the U.S., inflation reached levels not seen in decades, with consumer prices increasing by over 5% in 2021 and 2022. Misallocation of funds. A significant critique of the central bank strategy is the misallocation of the newly created money. Ideally, this money would flow into sectors that could generate a multiplier effect, such as infrastructure, education, or healthcare, thereby stimulating broad economic growth. Instead, much of this money has gone to large financial institutions and corporations. BlackRock, one of the world's largest asset management firms, serves as a prime example. The Federal Reserve enlisted BlackRock to manage its corporate bond buying program, resulting in substantial investments in Wall Street and specific corporations. This not only benefited BlackRock, but also led to inflated stock prices, creating a falsely positive market impact. While stock markets surged, the benefits were disproportionately enjoyed by wealthy investors and large corporations rather than the general population. Political complicity and market manipulation. The role of politicians in this scenario cannot be ignored. The administration of President Joe Biden, like others before it, has often highlighted the booming stock market as evidence of a healthy economy. However, this narrative can be misleading. A rising stock market does not necessarily reflect the economic well-being of the average citizen, especially when wage growth remains stagnant and income inequality widens. Moreover, there have been allegations of insider trading among members of Congress. The remarkable investment success of some Congress members raises questions about the fairness and integrity of the system. For instance, reports have emerged about members of Congress making timely stock trades that coincide with confidential information about impending policy changes or economic conditions. This behavior erodes public trust and suggests a level of corruption that undermines the principles of a fair market economy. The consequences for future generations. The long-term consequences of these policies are dire. While a select few have profited immensely, the majority of the population faces an increasing debt burden. Future generations are particularly at risk, as they will inherit an economy hamstrung by high levels of public and private debt. The cost of servicing this debt could stifle economic growth and limit opportunities for innovation and investment in critical areas. A call for reform. Given the current state of affairs, some argue that drastic measures are needed to rectify the situation. Proposals include removing and replacing those in power within the White House, Congress, and the Senate, and transforming the Federal Reserve from a privately owned entity to a public institution accountable to the citizens. This radical overhaul is likened to an assassin attempting to revive a long-dead patient. The systemic corruption and deep-seated issues within the financial and political systems are so entrenched that only a complete reset may offer a chance for meaningful change. By addressing the root causes of economic disparity and ensuring that monetary policy benefits the broader population, it may be possible to restore trust and create a more equitable economic future. In conclusion, the deliberate actions of central bankers, influenced by powerful backers, have created significant economic challenges. Misallocated funds have exacerbated income inequality and led to a falsely positive market narrative, while the general population bears the burden of increased debt. To address these issues, comprehensive reform is essential, including greater transparency, accountability, and a re-evaluation of the role and ownership of central banks.